Perfect. Okay. Hi everyone. My name is Charlie Kaufman. Today I'll be walking through a full Python implementation of a portfolio risk system with value at risk and stress testing. We will read through the code together line by line, and I'll explain both the Python syntax and the financial meaning behind it. And then at the end, I will um, explain and interpret the data. So to start, I use these to import things that I needed. This one does numerical connections, pandas, we've used that, data frames, and then Yahoo Finance is to get scab or current stock prices. And then this one is Skippy stats is gives us normal distribution functions for the DAR. And then this one is for using plots in the chart that I made below. And then this one is for working with dates. So here we're just, laying out the parameters. So the portfolio is 1 million. The confidence level is 95%. This is the number of trading days. Um, this is 2 years of data. And then here are the tech slash auto and oil securities we're going to use. And then these are the weights. We're just used each equal weights for all of them. And then the annual risk-free rate is 2%. Um, these are all values that will drive the calculations that we're going to use. So moving on to um, what? Oh, so sorry, I scrolled too far. I was looking for risk limits. Here is our VIR limit of 2% a day, and then our if we lose 5% in one day, that triggers escalation. And then this one is a shortfall of 1.1. It should be at least 10% bigger than the VIR. So these lines define the download prices. The key part is rates. Where's the um what? Oh, here. Sorry, I was on it already. And this tells us Yahoo Finance to adjust to get the adjusted close prices for all of our tickers between the start and end date. And then I added extra days to the start date so weekends and holidays don't cut into our sample short. Without that much history, the VAR estimates are unreliable, so we pour more data than needed and then trim it to the correct window. So moving on, I don't think I really need to touch up on those. The compute return rate here, um, it drops missing values and does this, it just does this, but drops missing values. And this gives us our daily percentage changes for each stock, our return series. And then this first line computes here in historical computes portfolio returns by multiplying um Oh, everything goes in there. Not this line. I'm sorry. This line right here and this line right here. This first one computes portfolio returns by multiplying each day's returns by our weights and summing. And then the second line gets the fifth percentile for 95% VAR. And then line 70, so this one, param, oh, parametric VAR portfolio. Oh, it tells you right here. So this calculate mean returns, the covariance, the portfolio mean, which is this one, and then, or no, sorry, the portfolio mean, which is this one, and then the standard deviation, which is this one, and then a Z score for that confidence level right here. These parametric numbers assumes returns are normal and uses volatility plus correlations to get the VAR. Moving on to this line, it simulates thousands, or this right here simulates thousands of random return vectors from the mean and covariance matrix, and then um it applies weights and takes the percentile as a VAR. And same as up top there. We calculate the mean returns and the covariance and the portfolio mean, etc. And then moving on to expected shortfall. Oh, this averages out all returns worse than the VAR cutoff. So, yep. Apply because the stress this takes a vector of the stocks one per asset and then computes total portfolio loss. Um, this whole chunk, and then let's see, this um builds shocks from real historical date ranges. Back is these lines count how often actual returns fall below our VR threshold, which is also known as what was it? The breach rate here. And then recording. Oh, this is just our verification method, and if it exceeds the threshold limit here. And then here is our main function. And so first we download the prices, which is just getting the data, and then we compute the returns, which convert to daily percentage changes. And then we print daily and dollar losses here. And this is both versions. And then this is simulated distribution. And this is for tail losses. This is for breach counts. And then this is a stress test. And then it's 2008 or synthetic severe scenario plus a custom negative 20% drop. Uh, and the custom shock examples, and then the risk monitoring, simple dashboards. Oh, and then this annualizes volatility, the returns, and then VAR lines, and this will print warnings if the limits are exceeded. But this is the histogram, and it will visualize the returns, and you'll see the VAR lines and down below. So now I need to break this down. I'm sorry, I just gotta find my notes. So complete comparing the three values or calculations, we have the historical and the parametric and the Monte Carlo. The historical is based purely on past data. It's showing. Uh, oh, here's our histogram, but I'll come back. I'll show that later. Um, and yep, here are all the numbers that I'm going to be starting to talk about. But the parametric VAR assumes returns are normally distributed and uses our portfolio's volatility and correlations to estimate risk. The Monte Carlo VR simulates thousands of possible returns based on our mean and covariance, so it can capture a more diverse and like set possible of outcomes. And then building on that, if the historical VAR and Monte Carlo VAR are close, that means our historical data is represented well by by stats. If the parametric VAR is much smaller, it's probably underestimating the tail risk of the data. Sorry. So next is the expected shortfall ES, which is larger than VAR because it doesn't just measure the cutoff point, but it averages all the losses worse than that cutoff. I think the VARs are like a cliff edge, and the ES is basically how far you'll fall once you go over. So if ES is significantly larger than the VAR, it means that the tail is beyond worse of 5%. Or that 5% is, I mean, that's a red flag and just means extreme risk events. Then the back test here, so we expect that about 5% of days should breach our 95% VAR level. If the actual breach rate is close to that, that's awesome. Our VAR model is calibrated well. If it's much higher, that means our VAR model is too optimistic and underestimates risk. If it's much lower, then we might be overestimating risk, which is safe, but it can also constrain our trading if we make less money, which is not what we want. So then moving on, so just back to this, oh, so our stress test results, looking at the first here the historical scenario, which is an example of the 2008 style crash or synthetic severe drop. This tells us in concrete terms what would happen if our current portfolio um, dropped like that, or if that event ever happened again, like what our portfolio would look like. And if we see losses in the 30 to 50% range from these shocks, that means our portfolio is highly exposed to systematic or systemic well, I cannot say that word. System market. I want to say that word, but I can't. basically system market crashes, and we need to reduce concentration or add hedges. The custom uniform 20% drop scenario is more of a simple sanity check. It tells us if every asset dropped by 20%, here's what's going to happen to the whole portfolio. Moving on to alerts. Now, if we see messages here, they're telling us which limits we've crossed. For example, here, our VAR limit breaches means our 1-day risk exceeds the board's tolerance. That's a signal to cut position sizes or add diversification to the portfolio. An ES VAR ratio alert means our losses are beyond, or our losses beyond VAR are too large, which could prompt us to add tail hedges like deep out of money puts. So the dashboard or Sharp ratio justification. This basically shows us annualized volatility, the annualized return, and the Sharp ratio. Obviously, it's labeled. If the Sharp is too high, like say above 1, that suggests we're getting compensated for the risk we're taking. If the Sharp is high, or if the Sharp is low or negative, and the VAR is high. That's worse. That's the worst case because we're taking a lot of risk but not getting enough return for that risk. And then finally, the histogram, which is my favorite part because it's not just numbers and text. It shows the distribution of our daily portfolio returns. The vertical dash lines show the historical, parametric, and Monte Carlo VAR levels. If the histogram had a long tail left, meaning the bar heights stretch far into the negative returns, that's visual proof of an extreme downside risk. The visual is one of the most persuasive tools for the board. They can literally see how often and badly the portfolio could lose. It's a lot easier to see than looking at these numbers. I think that's a common thing for everyone. So putting it all together, if historical and Monte Carlo VAR are both high, yes, is significantly bigger than VAR. The breach rate is above 5%. Stress test shows huge losses, and our Sharpe ratio is low. That's a clear sign that our portfolio is too risky. In that case, I'd recommend reducing gross exposure, rebalancing toward less correlated assets, and then maybe hedging some strategies. If all the metrics are within limits and the Sharpe ratio is strong, we can be confident our risk profile is healthy, but we will still have to monitor this daily. So, honestly, that's basically all I have. And now that we've gone through every line of code, or most lines of code, and show how it connects to the financial side, it can be adopted into any portfolio with real data, real-time data, and you could have a live VA monitoring for your phone. Thanks for watching. Yeah.